focus now upon the earnings season and specifically on banks, especially after the demonetization drive, the huge accretion to CRR and the low-cost deposits that we've seen. How does the quarter gone by look like for banks? Are the financials likely to post a weaker Q3, and what impact is it likely to have on Treasury gains, which have, mind you, supported banks all through the last 2 quarters during the lean credit extension period and at a time where public sector banks have been pruning the size of their corporate book? To shed more light on this and to discuss the numbers in detail, joining us on the show is Ravikant Bhat. He's research analyst at IDBI Capital. Good morning, Ravikant. Good to have you on the show. Let's start off with what your expectations from the public sector banking package. I realize, of course, you track the private sector more closely and 4 banks there. But overall, if you were to give a view as far as the public sector banks go, I read from your report that you would prefer to compare it sequentially, given the fact that you had a lot of non-tax provisions which dragged the profitability in the last quarter. So this time around, there's expected to be a quantum leap and then some improvement going ahead?
Well, no, I mean, as we pointed out and as we have said in our report, we are looking at this as we will be comparing results in this quarter on a quarter-on-quarter basis rather than on a year-on-year basis. Now, if you look at what happened in the second quarter, the gross NPAs on a year-on-year basis were up almost 100%. But if you look at the quarter-on-quarter trend, the growth in gross NPAs had slowed down to approximately 6.5% for the public sector banks, and it was a similar number for the slightly lower for the banking sector as a whole. So there has been an improvement trend, and in fact, the top public sector banks, at least 5-6 names, they were in the green, whereas the other banks were not, though the losses had come down. So on a quarter-on-quarter basis, there has been an improving trend. The provisioning also, which on an aggregate basis was about 433 billion in third quarter of FY16, it had come down substantially to about 350 odd billion by second quarter. So we would be looking, at this on a quarter-on-quarter basis. We do believe, given that a lot of large corporate pain is in the numbers, there has to be an improving trend. The only what I would say is a kind of an imponderable, though there is a RBI forbearance for the smaller ticket loans, and therefore that may not show up really. But one way of looking at it would be, all analysts would be looking, or rather tracking the asset quality number as in what it would have been had the RBI forbearance not come in, and what it has been under the RBI forbearance for the smaller ticket loans. That apart, otherwise it should show an improving trend.
Right. Ravikant, you also mentioned that NIMs are only expected to weaken going ahead from here on, given the expansion in base of interest earning assets. And also you mentioned about the the possibility of spreads thinning because of deployment of shorter term paper. I mean, be it reverse repo or be it the MSS that has been launched, and we are seeing constant tenors being, tranches being churned out.
That's correct. So we have been alluding to this phenomenon which happened in Q3 of 09, wherein State Bank of India had a huge inflow of deposits in one particular quarter, whereas the incremental offtake in credit was very weak. So incremental CD ratio in that quarter was just about 15% for SBI. What has happened now, though the drivers this time are different, but it has happened system-wide, is that you have again seen a lot of deposit inflow, and with the withdrawal curbs and with the backdrop of a weak credit demand as well as a weak credit demand outlook in the near term, you have had this liquidity overhang amongst the banks. So that obviously is leading to banks having to earn a suboptimal rate of return on their liquidity. So you have a situation wherein liquidity gets deployed in reverse repo, and we had then MSS. You had in between CRR also, which did not earn anything, but that again was fleeting phenomenon. If one were to talk of otherwise the rest of the quarter, the deployments were largely in the shorter term instruments. MSS is still running some shorter term instruments. So obviously you have an expanded base of interest earning assets which are not necessarily yielding the older average rate of return which banks have had. So this obviously is going to put pressure on NIMs. That said, what we have also been pointing out is this kind of a liquidity inflow was never factored into the estimates, and therefore this is going to provide a certain top line growth which otherwise was not existent. So you will have a better top line growth, but you will have mathematically the NIMs are going to be weaker.
Right. Continuing on the topic of NIMs, Ravikant, if you can also highlight to us, we've had this huge accretion to low-cost deposits. So, of course, the lower CASA will be a theme. But again, the MSS issuances will be calibrated to the extent of the withdrawals that take place of these low-cost deposits. And as you've also mentioned, with regard to the spreads thereof. So, I mean, this probability of the withdrawal of the CASA will have to be taken into account in the calculation of the MCLR. To that extent, how much of cooling off in the MCLR further from here do you see? Because the bigger names like SBI have already undertaken a 90 bips. More appetite going ahead from here on?
That's correct. So the way MCLR is calculated is it's dependent upon the incremental inflows into respective buckets, and those buckets are weighted. So I'm presently presuming that outflows would also be factored in, because otherwise it would bring in some short-term volatility in MCLR. Because once the withdrawal curbs are lifted, and SBI management has been on record that they expect 40% to stay and the remaining to flow out. So then it again skews, as in the weightages again change, the CASA weightages drop, and the term deposit weightages go up, and that may also affect MCLR. And again, I mean, MCLR is compulsorily, it's not compulsory, but banks are voluntarily reviewing it on a monthly basis. So again, so we are presuming that possibly this kind of outflow and the change in weightages to the shorter term deposits or the CASA deposit buckets are factored into the MCLR. So if one were to think of how much lower can MCLR go, MCLR can also be influenced by the term deposit rates, which have which we have seen banks reducing consistently over the last few quarters, and that could be another driving force which can pull down MCLRs. But talking overall of the lower MCLRs effect on the NIMs, it would be, I think, correct to assume that NIMs would continue to see some pressure in the near term.
Right. Ravikant, one major cushion and one redeeming feature has been the amount of treasury gains that some of these bigger public sector banks have also been beneficiaries of. I mean, they've transferred the adequate amount from the held to maturity to the AFS book, booked profits. And in a time where banks have consciously pruned down the size of their corporate exposure, credit growth has been very sluggish, be it any category. Treasury gains have supported a lot. After the 7th of December, the yield spiked up again. I mean, we touched a low of 6.1, but the yields post that have been all over the place, a little volatile. Do you believe that the upside for these treasury gains this quarter onwards could likely be limited, and therefore, in an environment where MCLR is going down, treasury gains are limited, some profitability impact could come through in the second half, or maybe could trickle to the first quarter of the next FY?
So I agree with the overall assessment, and that's the one area which causes a bit of an anxiety. Because if you see the second quarter results, again at a sectoral level, the other income was up almost 60%, and on a QOQ basis it was up 30%. So it's a valid question whether treasury gains can continue to support the profitability, and also because but for the treasury gains, there again would have been a significant losses in second quarter for the sector. So there are two ways of looking at it. One is, as you pointed out, obviously the yields have been volatile. If we really move, if the interest rate outlook, or rather the inflation outlook, remains soft, and we continue to stay in a softer interest rate scenario outlook, then possibly there could be some sideways movements of the yields, and some elbow room might be available to book further gains. And it's not that banks cannot sell their HTM. The issue is they really don't end up booking all the gains which they are really sitting on all the book gains they are really sitting on. So I suspect the room over here is kind of thinning, or rather it's coming down. The second aspect is on the provisioning side. So assuming that the treasury gains do come off, and you are also talking of NIM pressure, you are then looking at the provisioning line, which hopefully should start improving, or which I mean it should start coming down, and that could provide another support. So treasury gains come off and provisioning also softens a bit. You are still a bit in the safe territory.
Right. Ravikant, let's come to your picks then. I mean, your coverage universe, and let's specifically stick to Axis Bank and HDFC Bank for the moment. What are your key expectations from these two private heavies, given that, you know, the mortality from the watch list, as you've highlighted in the Axis Bank numbers, will be key to watch out for? How much of that goes off, and what's the watch list? How much of slippages have been there for Axis Bank? And for an HDFC Bank, I mean, it's mostly stable, right?
So, talking first of Axis Bank, the management was very clear in the second quarter that their initial expectations of 60% mortality from the watch list might actually go up. So, we are now assuming almost about 100% mortality, and in our estimates, we were factoring that this mortality to be spread over this year as well as FY18. And now we are looking at almost 80-90% of the watch list mortality happening in FY17 itself. So that's how we are factoring it into our estimates, and we have really pulled down our numbers. We turned negative. We had turned negative in the first quarter. We are running a sell recommendation on Axis. So we are not really seeing asset quality pressures receding. The good part, as we have been highlighting for Axis Bank, is they are actually doing really well on the liability side. They have got a really good franchise strength over there, and they plunged into retail assets much well in time. So they have gained some kind of a good position and a leadership position over there also in terms of growth. So that should support earnings to an extent. ROAs, which used to be very good, like other private banks, around 1.5%. I think the ROAs are coming down to below 1%. Average, they should average out at around 1%. Coming to HDFC Bank, the issue really is while everything is still good on the liability side, we have seen the asset side undershooting our estimate. So on a full year basis, we were estimating about 22 odd percentage year-on-year growth on the credit side, but it's been really a sluggish first half for HDFC Bank. And the way we do our numbers is we actually look at the pattern in which the growth is happening. So last year, of the incremental growth of HDFC Bank, around 53% happened in the first half, and the rest of the book grew in the second half. This year it's really on the weaker side. And while retail assets might still do a bit well, on the business banking side, I think they might be into a slow trajectory now. So what we are really seeing is a back-ended growth happening for HDFC Bank. If at all they're able to achieve that 22% we were estimating, we believe it might actually be lower, and because of the back-ended growth, the earnings growth might also slow down. So I don't think HDFC Bank is sticking anywhere close to its 20% year-on-year net profit growth run rate, which it has been delivering for the last many quarters. So I think it's going to slow down for this quarter as well as the next. I'm sorry, for the third quarter as well as fourth quarter.